When you enter into uh, almost any agreement in daily life, say buying a car or hiring a contractor, the legal side of it is usually pretty straightforward.
Right. There's an offer, there's an acceptance, values exchanged.
We call that a meeting of the minds in common law, and the contract is binding pretty much instantly.
It makes perfect sense. You agree, I agree, the deal is done. And when you look at an insurance application, especially for life or health coverage, it really seems to follow that exact pattern.
It does. The company promises a huge benefit if something bad happens.
Yeah.
And you promise to pay the premiums. Simple.
Uh-huh.
But our sources reveal that the process of forming a valid individual Canadian insurance contract is actually one of the most counterintuitive things in common law.
It is.
It's anything but simple. It's a real minefield of unique legal steps.
And that is the mission of this deep dive. We're looking beyond the signatures, beyond that initial premium payment. We're going to dissect the unique legal steps required to make an individual life, accident, or sickness policy truly valid. We'll look at everything from, say, the agent's liability to the critical 2-year window that protects consumers who acted honestly.
Okay, let's unpack this initial legal twist, because it's a big one.
Yeah.
Who is actually making the offer and who is accepting it?
Well, in the everyday, practical sense, when you meet an agent, fill out pages and pages of forms, and sign that application, you probably feel like you're making the offer to the insurer.
Of course.
You're basically saying, I offer to pay you X dollars per month if you cover my life for Y dollars.
That's certainly what it feels like. You're applying for something.
Exactly. And practically, a lot of people think that once the application is approved and they've mailed in that first check, the contract is done and dusted.
Sure.
But legally, under Canadian common law, the flow is it's often flipped, and that flip has massive implications.
Wait, hold on. If I filled out all the paperwork and gave them a check, why am I not the one making the offer?
Yeah.
What legal distinction are we missing here?
It all comes down to control over the final terms. When you sign the application, you're only providing information and proposing terms. The insurance company then takes that information, they assess the risk, and they decide how they're willing to cover you, or if they're willing to at all.
So they might change things.
They might. They could decide you're a higher risk, add exclusions, or change the premium.
So my application is really just an invitation for the insurer to propose coverage to me.
Precisely. Once they finish the whole underwriting process, they generate the official policy document and send it to you. The act of the insurer tendering or delivering that finalized policy that is legally considered the offer.
Wow.
And the acceptance that only takes place when the applicant, after reviewing the final terms, decides to physically take possession of that policy.
That's a fundamental shift in power. It means I, the applicant, have the legal right to inspect the final contract and just walk away right up until I physically take it.
Yes. The contract isn't done until you say, yes, I will take this policy on these terms.
And it's not that simple, is it?
No. This final acceptance phase is complicated by a whole checklist, especially for life insurance. The validity of the policy relies on a lot more than just that final handshake. We're talking the application process, temporary coverage, changes in insurability, final acceptance, the premium payment, and of course, the delivery of the policy.
Okay, let's dive into that first critical checkpoint. The application and this duty of disclosure. We sign those pages, warranting that every answer is accurate and complete. That seems straightforward, but this is where the agent's behavior can. It can actually invalidate the entire contract.
This is where the legal liability becomes incredibly steep for the insurance agent. They're the intermediary, right? They're helping the applicant navigate the forms. But the agent has an explicit, strict duty. They cannot, under any circumstances, paraphrase or change the wording of the insurer's questions.
I can totally see why an agent would want to simplify things, though. Insurance forms are notoriously long and complex. Why is simplifying such a huge risk?
Because every single word in that application question is carefully constructed by the underwriting department to get a full disclosure of a material fact.
I see.
If the agent simplifies the wording, they are potentially hiding an essential piece of information that the insurer needs to accurately price the risk. And if the policy fails because of that, the agent is on the hook.
Let's get into that incredible example from the sources about Agent Georgina.
Right. So Georgina was facing an applicant with a complex medical history. The policy form had this highly specific section listing 21 potential symptoms or disorders relating to the brain and nervous system.
21. That's overwhelming.
It is. Everything from seizures to chronic fatigue. And Georgina, well, she decided to speed things up. She just looked at the client and asked a casual, simplified version.
What did she say?
Something like, "You don't have any problems with your nerves or brain tumors or anything like that, do you?" She basically boiled down 21 specific points into one easy question.
And if that client later has an issue with one of the other 19 things on that list?
Exactly, something the insurer would have flagged. Georgina's simplification has created a massive legal loophole. Her failure to use the exact wording risks the whole policy being voided. And you can be sure that when a claim arises, Georgina will be right in the middle of the lawsuit.
That is genuinely shocking.
Yeah.
But there's an even more sort of insidious threat to validity that listeners need to know about.
Yeah.
Let's talk about this silent killer principle, changes in insurability.
This is a huge, critical concept most policyholders just don't realize exists. If your insurability, so your health status, your job, anything that impacts risk, if that changes between when you sign the application and when the policy is delivered, the policy does not take effect.
But I paid the premium, I signed the form, they approved it. Why would a health change during that waiting period just void the whole agreement?
Because the insurer agreed to underwrite the specific risk that existed on the day you signed. They're entitled to reassess that risk if a significant change happens before the policy legally kicks in. If you get a dangerous diagnosis or change to a risky job in that period, the original policy terms just don't apply anymore.
And the burden of disclosing that change is on me, the policyholder.
Right.
All the way up until delivery.
That's right.
But change in insurability is an underwriting term. It's not common language. How is an average person supposed to know what counts as material enough to disclose?
And that's the difficulty, which is why applications usually ask very specific, very broad questions about doctor visits and treatments.
Right.
Take the example of George. He applies in October. Policy is ready for delivery in December. In late November, he goes to his family doctor for a routine annual flu shot.
Okay, seems minor. So if the agent asks George, has there been a change in your insurability? George might honestly say no, right? A flu shot is routine.
He might. But the fine print in the application typically requires disclosure of any visit to a doctor or any treatment received since the application date. George must disclose that appointment. The insurer then reviews that updated info. If they're satisfied, great, they deliver the policy. If not, they might delay, reclassify him, or even decline coverage. It just shows that the duty of disclosure is continuous.
So once that hurdle is cleared, we get to the final mechanics. The insurer tenders the policy, which we now know is the offer. What happens next?
The policy isn't in force until all the delivery requirements are met and the first premium is paid. Now, here's a subtle but important legal difference between policy types you should know about.
Okay, what's the split?
For life insurance policies, the contract doesn't become effective until two things happen: the delivery of the policy and the payment of the initial premium. You need both.
And the other type?
For accident and sickness insurance, the contract only requires delivery of the policy to be considered in force, whether or not that first premium has been collected yet.
That's fascinating. I would have just assumed payment was the universal trigger for coverage.
It's a subtle mechanism, but yeah, it's an important one. We also sometimes see policies that are backdated.
Backdating sounds a little risky. Why would they do that?
It's usually just to save a younger age for premium purposes. Premiums are based on your age, so if you had a birthday during the underwriting process, backdating saves you money over the life of the contract.
But there's a catch, I assume?
The catch is you have to pay the premiums for that entire backdated period, even though you only got the policy much later.
Right. And since underwriting can take weeks or even months, what protections are there for the applicant during that waiting period? You mentioned temporary insurance.
Yes, a key consumer safeguard. Temporary coverage is designed to bridge that gap between application and delivery. If the applicant can confirm a few key facts, usually by answering no to 3 or 4 questions about recent hospitalizations or serious illness, they can get limited protection, usually for about 90 days.
So if they died tragically in an accident while the underwriters were still reviewing their file, their family wouldn't be left with nothing.
Exactly. The insurer would likely be obligated to pay the death benefit up to a set maximum limit, provided the initial info was accurate. It's a recognition that you're in a vulnerable position while you're waiting.
And even after all of that, the application, the disclosure, the payment, the delivery, the consumer still have one last way out if they have buyer's remorse. The famous 10-day free look.
A very powerful legislated right. The policyholder can rescind or annul the contract within 10 days of delivery. This free look lets you take the policy home, read every page, and if you realize it's not what you expected, you can walk away.
And you get a full premium refund.
A full refund, no questions asked. It gives the applicant that final piece of control.
Now, policies can also terminate voluntarily. The policyholder can just surrender it at any time, which ends all rights.
And if it's a permanent policy, that surrender triggers the payout of the cash surrender value, the CSV. And of course, term policies can also just end naturally by expiry when they reach their age limit.
Let's pivot now to the darker side, when the insurer terminates the policy. This almost always comes down to honesty and disclosure. And this is where that 2-year timeline, the contestability period, becomes so important.
It is.
First, let's clarify the difference between just a misrepresentation and outright fraud.
Right. A misrepresentation or concealment can be made in good faith. Maybe you honestly forgot about an ankle surgery from 15 years ago. It's an innocent mistake.
And fraud.
Fraud is defined by the intent to mislead. This is the deliberate lie, the intentional omission of a material fact.
Like saying you're a non-smoker when you smoke a pack a day.
Exactly. Or intentionally not mentioning a recent cancer diagnosis. Intent is the key legal difference.
Now, if the insurer catches a lie during the application phase, before the policy is even issued, what happens?
They have maximum flexibility. They can adjust the coverage, or if they just lose trust in the applicant, they can decline the application entirely.
Like the example of Josephine.
Yes, Josephine. She purposefully knocked 5 years off her age on the application for lower rates. The agent caught it when checking her ID, corrected the application, and the insurer adjusted the premiums. The policy went through, but the lie was fixed before it became a legal mess.
But the law has a unique protection for age, doesn't it? If that mistake is found after the policy is in force, even if the person lied, the policy can't be terminated.
That's a key consumer safeguard. Instead of canceling, the insurer just amends the contract. They adjust the coverage amount or the premium to what it should have been for the correct age. They can't just void the whole policy for an age mistake once it's active.
Okay, this brings us to that crucial 2-year deadline, the incontestability period. How does that clock work?
The 2-year period provides stability. If a non-fraudulent misrepresentation, something made in good faith, is discovered during those first 2 years, the insurer has the option to cancel the policy if the issue is material. But they don't have to.
And after those 2 years are up, what happens to those honest mistakes?
The policy is legally stabilized. After 24 months, the insurer can no longer cancel the policy based on any misrepresentation that was made in good faith. That 2-year limit gives people confidence their coverage won't be yanked away years later over a forgotten detail.
Jacob's story is a perfect example of this, isn't it?
It is. Jacob got a policy, but a few months in, he realized he'd forgotten to mention smoking a single cigar at a bachelor party. It was a good faith error, and he raised it with the insurer within that 2-year window.
And what do they do?
They reviewed it, still categorized him as a non-smoker because it was so infrequent, and took no action.
And now he's protected.
Exactly. Now that the contestability period is over, they can't suddenly decide 5 years from now to void the policy over that one cigar. Jacob is protected.
But the shadow hanging over this entire safety net is that huge exception: fraud, intentional deception.
That's the one thing that overrides everything. If intentional deception is involved, what the law calls fraud, the 2-year incontestability period does not apply. The insurer can cancel the policy for fraud at any time and refuse a claim.
Tell us about Arn. His story is a tough one.
Arn passed away 3 years after getting a life insurance policy, so well past that 2-year window. His family submitted a claim. But during the review, the insurer found that Arn had failed to disclose a major surgery for cancer just 4 months before he applied.
And that was deliberate concealment.
It was deliberate material, which means it was fraud. And because of that, even though the policy had been in force for 3 years,
The insurer could refuse the claim.
that's right, they were legally entitled to refuse the death claim, completely overriding the contestability period. It just proves that honesty is a constant requirement.
Finally, let's briefly cover the most common reason policies lapse: non-payment, and the final safeguard: reinstatement. For sickness and accident coverage, how long do you have?
Well, if the policy was delivered, it stays in force until the insurer sends a registered written notice of termination. The cancellation takes effect 10 days after that notice is mailed.
And for life insurance?
Term life policies or permanent ones without enough cash value, just terminate after the standard 30-day grace period for non-payment passes.
But there's still a lifeline there, isn't there? The insurer is obligated to reinstate a life insurance policy under certain conditions.
They're obliged to reinstate it if the client applies within 2 years of the cancellation date, and if the insurer determines that the client still meets the insurability conditions of the original contract.
So if you hit a financial rough patch, but your health is still good, you have a 2-year window to get that original, probably cheaper coverage back. That's a huge piece of protection.
It is. It closes the loop and offers a lifeline for honest people dealing with temporary financial issues.
So what does this all mean for you, the learner? The core lesson here is that forming a valid Canadian insurance contract is less about when you pay and more about the delicate, continuous duty of full disclosure.
Right. The process is front-loaded with risk until that policy is in your hands, and the law draws a hard line. It offers stability for good faith mistakes after 2 years, but it maintains zero tolerance for fraud forever.
That tension between the complexity of underwriting terms and your duty to disclose is the crucial takeaway.
Exactly. We've seen that a policy can fail to even take effect if your insurability changes between application and delivery, a term that is, highly technical and pretty vague to the average person.
Which brings us to a final important question for you to mull over. Given this complexity and knowing the agents risk lawsuits if they try to simplify the terms, what practical common sense mechanisms beyond the 10-day free look could the Canadian insurance industry introduce to make concepts like change in insurability instantly and undeniably clear to the policyholder, helping you fulfill your legal duty without needing a law degree?